Welcome to today's event, the latest and greatest of blockchain, hosted by CFA Society Chicago's Education Advisory Group. Information about our upcoming events can be found on our website at www.cfachicago.org. I'm Chris Vincent, CEO of the Society. Thanks very much for joining us this afternoon. As for housekeeping, all mics for attendees will automatically be muted on our end. If you have a question for our panel, please use the Q&A feature, and the event is being recorded. Our discussion today will be moderated by Will Kong, the founding director of FinTech Initiative at Cornell University. Will is the Rudd Family Professor of Management and Associate Professor of Finance at the Johnson School of Management. Prior to joining Cornell, he was a faculty member at the University of Chicago's Booth School of Business. Will's research spans financial economics, information economics, fintech and AI, and entrepreneurship. He is widely recognized as a founding scholar of fintech research. He is the senior economic advisor for Chainlink and has advised BlackRock, DataYes, Definity, Wall Street Blockchain Alliance, among other industry leaders. He has also consulted for several prominent ICO litigation cases. Joining Will today are Bobby Hennebree, founder and CEO of Hennebree Blockchain and Cryptocurrency Consulting, LLC. Ben McMillan, founder and chief investment officer, IDX Insights, LLC, and IDX Digital Assets, LLC. And Jordan Prince, software engineer at Solana Labs. I will now turn it over to Will. Welcome, Will. Thanks for joining us.
Thank you very much for the kind introduction, Chris. It's a great honor to be here, even greater honor to be among our very distinguished the panelists here. I would like to start this panel by asking Ben, Bobby, and Jordan just to briefly introduce themselves, their work, their experience. One thing I can tell is they have a combined experience of over 25 years, almost 30 years of investing, thinking about in the crypto space, decentralized finance, NFTs, and blockchain, fundamental blockchain economics. So I'll start with Ben.
Yep, thank you, Will. So my name is Ben McMillan, one of the founders of IDX Digital Assets. We provide alternative solutions for institutional investors, so typically pensions, endowments, other wealth advisors, and we were relatively early in offering digital asset solutions for advisors and institutional asset classes. We focus traditionally on the hedge fund landscape, and we're roughly $700 million AUM AUA.
Thank you. Bobby, you want to go next?
Yeah, thanks, Will. Good to be together with everyone. Thanks for joining the Zoom here. So there's kind of two threads that bring me to this conversation. One, and my background has been in traditional investments. I was a partner in a RIA where I was 11 years, kind of traditional portfolio assembly, got CFA charter and all that. Was in a hedge fund for 3 years, kind of traditional structure, traditional assets. And I currently head up a family office, CIO as well. But on the crypto thread, I started a mining operation back in 2016, Ethereum at home. So I just was really nerdy in the space and I got into it early. And then I ended up taking a break from work for a year and a half, traveled the world. I've been about 55 countries now. And I just started really diving into crypto and consult with startups and speaking on it, CFA societies, business groups. And so I've just been in the ecosystem for a while. Yeah, so I just like nerding out on crypto, investing in it, and I talk to entrepreneurs every day all around the world in the space. So that's my background and what brings me to the call.
Thank you, Bobby. And next we have Jordan, who was a top student in my class when I was at the Chicago Booth School of Business. So
yeah, I knew I recognized you when the camera started. I was like, oh, I remember that was the hardest class I ever took at Chicago Booth. Yeah, for those of you who don't know, he used to have this really cool fun, like quantamental analysis class where you would try to build trading bots, and it was fascinating. I took it, I guess, at the end of my Booth career. Learned a lot. Ultimately, I ended up in in the blockchain world, I think a year and I don't know, 2 months ago, I did my first ever crypto transaction. I sent $100 from my Coinbase wallet to an Ethereum wallet, off in the ether. And it was $100, and then I thought, okay, I'll send it back. And I tried to send it back, and it was going to cost me $40 in gas to send back $100. And I tried the same thing in Solana, and there really aren't any transaction fees on Solana. It cost me almost nothing, and it was instant. And I was like sold. So I dropped Ethereum, never used it again. Went to work for Solana Labs. I've been there ever since. Mostly my work has been dealing with writing protocols. I, with another teammate, built the underlying NFT protocol that powers Solana NFTs, which are non-fungible tokens, which we'll talk about today. It's called Metaplex. I also built a lot of distribution protocols for NFTs, such as the protocol powering OpenSea right now for Solana, this thing called Candy Machine that people use to sell NFTs. It's pretty much the only thing they use to sell NFTs on Solana these days. So it was like my first year. And then recently I've gotten more into developer evangelism. We've been doing these events every week all over the world called hacker houses, where we host these, like, it's literally kind of like a co-ed fraternity. I don't know how else to explain it, where people just get together with a bunch of monitors and they bring their teams and they build the things they were already building, but surrounded by other people. And in some cases, they get to see teammates that they have never seen before because of either the COVID lockdowns or because they were fully remote. And it's a really nice time where everyone gets to know each other, and we, study sort of the art of building on chain, because we also bring in a lot of experts like myself and others to do office hours and teach them. And I've been focusing on that recently as well.
Amazing, amazing. I can't wait to chat with you all about this, with the economics of blockchains and decentralized finance. But let's start with something fundamental, right? When we think about the fundamental valuation of tokens, of DeFi projects, of NFTs, my immediate question would be, how do you actually value tokens or DeFi projects? Before I pass the kind of mic to you, I do want to quickly mention how economists have been thinking about this. It's not so much about the technical layer or the legal way of classifying tokens, but more on economic functions. For example, if we talk about Bitcoin, Ethereum, even stable coins or central bank digital currencies, these are essentially competitors against fiat or traditional currency systems or payment systems. There's a number of blockchain projects or tokens that we've seen through ICOs that are essentially what I would call platform tokens. They're tied to particular functionality of the platform, be it decentralized computation or decentralized storage, right? So over there, it's a little bit easier to speak of the fundamental, because we can try to measure the fundamental platforms. And then more recently, we have NFTs or tokens that basically give you ownership to products or services sold by potentially centralized service providers. That's fine. We know how to think about valuing products or collectibles or art forms. And finally, we have the tokenization of cash flows. A lot of the staking is getting in that direction. But if we are just talking about valuing future cash flows through the ownership of a token, in every intro accounting or finance courses, we have discounted cash flow models. But it'd be great to hear from you all who's been in this field forefront for the past decade or so. I don't know who wants to start. Anyone wants to jump in?
Ben, I saw you unmuted. You want to take the lead, or
I can jump in. So we get this question a lot, actually, because we interface, like I said, primarily with institutions who weren't necessarily early adopters in the crypto space. So when you talk to people that were early adopters, it's very much like early days of the internet. They're excited about the technology. They don't need to be sold on the specifics of what the DCF might look like. It's all about just kind of rising tide lifts all boats. But when you start talking to, a pension or endowment or somebody who's got a fiduciary responsibility, it very quickly gets into, how do I know this isn't a Ponzi scheme? And there's a slide I show all the time that just compares, I think it's Uniswap versus Coinbase, and it goes through, the metrics. And, just like Coinbase provides a utility in this case, exchanging crypto tokens. So does Uniswap. Coinbase earns revenue. So does Uniswap. Coinbase has fractional ownership in the form of publicly traded stock equities. So does Uniswap. And so, I'm still surprised how often people are surprised at that there's protocols out there, most in fact, that actually have real economics associated with them. I will say the tokenomics gets a little bit nuanced. Not every token necessarily gives you, conveys, governance rights and or, a claim on that cash flow. But the point to be made is that these things are earning real money. And so, traditional, you can back out standard things like price earnings ratios, price sales ratios. The other side of the coin is, what about things like meme coins or NFTs? And I think NFTs is probably, meme coins, of course, it's the greater fool theory. It's only worth something if somebody else is willing to pay more for it. Those are typically, very speculative. It's not unlike the pets.com that we saw back in the internet bubble. NFTs is interesting because what we've seen there, first of all, is more institutional interest in owning NFTs. And we've also seen too, and I'm sure Jordan will corroborate this on Solana, but we've seen a lot of NFT projects start to prioritize utility as opposed to just purely, artistic or cultural significance. And I think you're going to start to see, of course, play to earn is a huge thing. E-gaming is an obvious kind of intersection with NFTs, but in general, you're starting to see a lot more. The market is starting to discern, what is the use of an NFT beyond just, a picture of a board, of a Bored Ape or something. What can it get me access to? And so it's, to answer your question directly, Will, I think it kind of touches on all three of those parts. There's different ways to value, but more often than not, last thing I'll mention too is, of course, the network effects. When you look at things like the layer ones, Solana is a good example. We were very bullish on Solana early on because we saw actually our developers were the ones that started migrating over and doing projects in Solana. And when you get the critical mass of developers, then you start seeing the use case. And when the NFT boom happened on Ethereum, like Jordan said, gas fees, congestion went way up. People voted with their wallets and they went to Solana. And so you saw that, a large part of the network effect transfer over to that layer one. That's a huge source of value. So anyway, that's a bit of a hitting on multiple points, but that's kind of how we see it in the context of institutional investors.
Really. And I don't know if Jordan, you want to talk about your experience developing NFTs since
yeah. So I guess I'll headline it. 99.9% of all NFTs will be worth $0 after 3 years. 99.99% of all coins are worth nothing and are probably Ponzi schemes. That's just out of the gate. I think 90% of the price movements that you see in any coin are driven entirely by behavioral economics, have no underlying, factors that are driving them. I think there are special cases, like certain protocols that do actually have revenues tied to the coins, but because of the US regulatory environment, most governance tokens cannot explicitly be tied to anything. You literally have to say when you're launching these things that this will have no future functionality whatsoever. And people still ape into them. And the reason they ape into them is because they think at some point the regulatory environment will change, or they can do something offshore through a VPN that will allow them to gain some utility. But ultimately, they're trading something that's truly defined as worthless. And the same goes for the NFTs. A lot of these NFT companies, they publish these roadmaps, and they don't have the technical chops to even get close to accomplishing these roadmaps, or they introduce some utility that's basically a Ponzi scheme. Like NFT staking, almost always a Ponzi scheme, because like, where are these tokens coming from? They're getting minted, and you just kind of have to hope that you're able to sell them on a DEX before other people do. So it's a strange place, but I think like Ben alluded to, the 90s, I feel like it's 1993 right now. I think a lot of the stocks, a lot of the names that were around in the 90s, like eToys and others like them, I thought a lot of their valuations were driven purely by psychology. That's why they went to such crazy valuations, and there was a lot of FOMO, fear of missing out on getting into these deals, which is why investors paid outrageous sums to these entities. And I think the same thing is playing out in both NFTs and the coin space right now. People know there's some utility there. Like, they know that crypto can be used for something. They know that it will have a power in the future. In 1994 and 1993, people could feel it, right? But the technology wasn't quite there yet, and people hadn't quite figured out how to use it truly yet. And I feel like we're in that phase where people are just dumping money into anything, trying to scrape for yield, and most of it will just blow up. in the end. A good example is like algorithmic stable coins. I don't personally believe in them. I think you can't have any stable coin built on a coin that's supposed to stay static and a coin that's supposed to fluctuate. It's like trying to balance on an edge of a triangle, like a lever. I think it'll just eventually fall apart. I think people are experimenting with stuff, but mostly it won't work out, and a lot of people are going to get burned, and it's because they're just trying to get that 10,000% APY return. They're degenerates. They're chasing the gold.
Yeah, it's very interesting to touch on that stable coin side. I think there's quite a bit of reinventing the wheel of what monetary economists or central banks have done in the past. But there's also some innovative aspects to how people have been thinking about stablecoin. Before we delve into that, I do want to say that it's a stronger view than I thought you would present as someone who's working on NFTs. Bobby, what do you think?
Yeah, I have not invested in NFTs. I've got one that I've kind of played with. That said, I've looked at a lot of venture kind of investments, kind of private investments on platforms for NFTs. And I was just talking to a guy earlier today who's built a whole kind of metaverse development company that does a bunch of NFT work too. And so those are the conversations I get in. But I've seen kind of three phases of NFTs, and I think directionally what Jordan said is probably accurate. And the first phase was just, kind of crypto kitties and just make an NFT, like take a picture, hash it, right? But that's getting diluted, right? There's just so many people doing that in different ways. And then you got kind of the celebrity kind of digital autograph, which makes sense to some degree. Like if an athlete or a movie star signs and says, this is the first of a series of 10 or 20, there's value there in a digital realm, right? Depending on kind of the super fans in the group. And so, but we've kind of gone through that, and I think there will still be winners there, but price compression relative to what they were selling at last year. And the third phase is really about what are the rights that NFTs give you in communities. That's what's really interesting. For example, I mean, whether Delta Sky Miles or just think about the communities that exist right now, where there are these other currencies that we use, right? That can be traded for dollars, right? And kind of fluctuate effectively. So there are other digital or actual communities where people have super fan groups, and then 100 fans get these NFTs, and these NFTs give you rights to be on a Zoom call with the founder, or you get swag or whatever first. So there are rights that can be hashed, and that makes sense to me. And then there are other iterations that are coming out of that, where what does the community want, and what are the rights you have in an NFT? And the last thing is how to disintermediate Facebook, where all of us have an NFT that is kind of our sovereign likeness and image, and we can kind of get paid for how we are used in a digital realm. That's really interesting to me. But those are the three phases I've seen. But I agree with Jordan that there's just going to be a lot of NFTs that are just going to go to zero. But it only comes down to longer term. What's the value you're going to provide, and what are the contractual rights embedded in that NFT? That's what's interesting.
It sounds like there's going to be a long journey in terms of the iterations we have on many of these innovations. But safe to say, there are interesting designs, interesting economics that could potentially generate value. We just have to observe this market very closely. Now, Jordan did mention stable coins. If we put aside the exact mechanism for stabilizing token values for a moment, or if we think about more centralized version of that, central bank digital currencies, from a pure investment perspective, what's your thought on how investors can benefit from being exposed to the stable coin realm? Because the price is not going to fluctuate. You can't really kind of capitalize on the innovation.
But the price can fluctuate. Stable coins are not actually stable. It's purely the algorithm that keeps them stable. And we have a saying in the software industry, which is, if you want bug-free software, the solution is to not use software. And with this particular piece of software, you're basically relying on it to be perfect. Because if there's even the slightest imperfection, something bad can happen. For instance, with the Titan Iron contract on Ethereum, The only reason it eventually crashed was because someone used a greater than instead of a greater than equals in a single line of code. That's what ultimately caused the entire thing to explode. And you know what? I've done that several times in my life. Like everyone does that. The mistake is completely honest. And the reason that they couldn't fix it was because they deployed an immutable contract because they were trying to explain, like, part of building an algorithmic stablecoin is like once you launch it, it can't be changed or else you can be rugged. And so they deployed it immutably, which means any bugs are locked in place. So you've already got that going against you. That's already a headwind. Humans are imperfect. The second thing going against you is that even on Solana, on Ethereum, I think block time is 8 minutes. On Solana, it's 400 milliseconds. Well, the problem is that markets are actually reacting faster than 400 milliseconds. So you've actually got like the ledger updating at a slower rate than real life. And this can lead to sort of inconsistencies in race conditions. And when you have a network that can get congested, if the real life price movement far outweighs what's currently on the ledger, you can see a bunch of bots submit thousands of transactions to the cluster at once to try to capitalize on that arbitrage, especially if you have multiple pools of liquidity floating around. They have slightly different price points. That can cause the cluster to slow down. You'll have a longer block time. This will cause an exacerbation and the price differential that goes even further. And then you end up with this, endless spiral, right? And so, like, why would I ever trust my money to that when I can just go to Circle and say, hey, here's $1, give me a USDC coin, and they just do it? Like, ultimately, this is I'm kind of biased because I took one of the Federal Reserve chairmen gave this great class at Booth where he taught us all about how the Federal Reserve works and central banking. Ultimately, I do actually think central banks have a real part to play in the crypto universe. I think there's a real power in having some very smart humans determine how and when to inflate, like, sort of the base money supply, like the base layer where we price everything at, which is currently dollars or euros or yen, because they're able to deal with situations that you can't expect. Black swan events matter. And I like cryptocurrencies like USDC that are just one-to-one with those currencies. Algorithmic stablecoins, I think they're beautiful in theory, but I would never trust one. I just don't, unless an AI builds it, I don't think we'll ever pull it off successfully anyway. But granted, I'm biased. I'm more of a pessimist towards these things.
Definitely with you that it's not necessarily guaranteed to be stable. Just like a money market funds could break the buck anytime.
That's true.
Depend on the algorithm.
Yes.
Ben and Bobby, what do you think about this? And what about central bank digital currencies? They seem to be at least designed to be stable.
Yeah.
This.
Let me share a couple quick comments, and then would love to hear Ben's thoughts too. So personally, I think central bank currencies to me are not fundamentally cryptocurrencies because they're central, right? The whole point of blockchain and crypto in its purest form is it's fully distributed, right? Permissionless, right? And there's a tension in the world. There's always been this between decentralization and centralization. Even in, you're arguing with your parents, arguing with your boss, arguing with your country, right? I mean, there are kind of these different forms where there's always this debate. That said, and so they could still use blockchain to make a digital currency that's, country X digital currency, and it'll operate just like another currency. But because it's centralized, it can be changed or corrupted at any moment. They could choose to change the rules, right? So that's why I say it's not fundamentally. That said, from the regulator standpoint, it's great to have a digital currency because they can track. So kind of all the KYC and AML stuff that all of us have to go through normally, it's embedded in that blockchain. So to me, it makes sense for central banks to leverage this technology to have kind of more controls and monitoring capabilities in place. So that those are 2 points that I would share, but would love to hear what Ben has to share now.
Yeah, I would just underscore that exactly. I don't think anybody seriously looks at central bank digital currencies as being true cryptocurrencies. I think what's interesting about them, though, is it's a forcing function. It brings a level of transparency to the marketplace. It also brings a very effective on-ramp. Once there's CBDCs out there, you're going to have a lot more people just starting to use electronic money, whether it's fully decentralized or not. And that's going to just, bring a huge wave of adoption, into cryptocurrencies. The flip side, of course, is privacy concerns. If you look at China's CBDC, a lot of people don't realize it's a mechanism of control, and it's very effective. It's programmable money, so they can flip it on or off. They can force you to only use it at certain times of day, certain days of weeks, certain stores. And so, there are very real, privacy considerations that the US dollar, physical dollar doesn't have. And I do think we're going to see, algorithmic stablecoins, I think, are an interesting theoretical exercise and will never be more than that. I don't think you see any kind of serious use case, and you're seeing that in the executive order, started with the president's working group and now the most recent EO. It's all about stablecoins. It's all about standards around transparency, collateralization. Tether, I think the CFTC levied the first ever fine on Tether for opaqueness around collateralization. So you're going to see a lot of the regulatory firepower aimed at ensuring stablecoins are in fact, stable and transparent. And I think you're going to see a rush for a U.S. federal coin. I actually think this latest war in the Ukraine has kind of demonstrated to the world that we're in a post-dollar hegemony era. We're on the kind of the part of the curve in which dollar's dominance is waning, and what's the next currency? Who knows? But it's digital currencies are certainly going to play a role, I think, in kind of dollar-denominated commerce in the next 10, 20 years. And so the Fed has to be looking at that as a way to just compete at this point.
That's very insightful remark. Yeah, in fact, a few researchers, myself included, have been researching on the country's perspective on developing digital currencies, especially for small open economies. They have to think about how to avoid digital dollarization at some point. And they can either look into private run stable coins or some sort of cryptocurrency. But I think it's a good point to kind of take the topic away from cryptocurrency per se to think about institutional adoption of blockchain. It could be in terms of institutional adoption of digital assets, but at the same time, it could be just adoption of blockchain as a distributed ledger, even without cryptocurrencies. Right? I've looked at some data on blockchain adoption. You can show on-chain data growth, even without cryptocurrency, can positively predict firm fundamentals and stock returns. What is your thought and experience on that, especially blockchains without cryptocurrencies?
I got a few thoughts here on this, and I've seen, my first client was actually a group that was trying to take syndicated loan origination and put it in a blockchain, right? Which made sense theoretically, right? If there's 60 banks that are doing syndicated loans and a few of them syndicate it and all the protocols in place, regulators on top of that would love that to kind of monitor, because everybody's on a blockchain and each node is a participant that's been approved to transact, right? And so, but it was really hard. They weren't able to do it to get the system to change, right? So it's really hard for and I would call that kind of like a pure play kind of blockchain application, right? And it was hard. So then I realized the easiest way to have a blockchain implemented in an industry is it's got to go in through a centralized industry. Like Walmart, for example. Like Walmart can tell all of its suppliers to do whatever it wants. And I'm not saying Walmart is doing this. I'm just saying as an example. They could force down, blockchain applications that track and coordinate and whatnot. I was like, that's kind of backwards, that you got to go through central to get it, decentralized blockchain applications. But the last point I would share is, there's got to be an entrepreneurial incentive for a blockchain to work, and cryptocurrencies provide an entrepreneurial incentive, whether it's through proof of stake and staking. You're rewarded for the work you're doing to prove a transaction, just like in proof of work, you're rewarded. I was a miner for a couple of years in Ethereum. You're rewarded to process the transaction. So if you remove that entrepreneurial incentive, what incentive is there for the participants to change their record keeping system to implement this blockchain? That's a real challenge. So the crypto, even though it's volatile and all this other stuff, it really provides incentives that are useful to make these blockchain implementations work.
Yeah, just on that front, I actually want to push back a little bit.
Sure, go ahead.
Aside from the entrepreneurial incentives, if there's a more transparent ledger system that allow people to make more timely updates and to forbid them from retroactively massaging the records, wouldn't it help, say, banks with their clients, after observing that the borrowers actually are posting their business operation information every day, reduce informational asymmetry and kind of ease off the terms on the loan, potentially. But I do hear you that, providing the incentives to include more people as record keepers is an important aspect of the technology.
And your comment makes sense. That said, there's a disincentive for them to do that because there's a cost of like changing the way the operations work. I mean, that's the hurdle. So you got to have a strong, CEO, I guess, for example, at the institution that says, all right, stop complaining. We're going to do this, right? That's how that change has to happen. But there's still a cost.
That has to be your earlier remark about having some sort of central control in order to implement a change that involves huge fixed costs, but in the long run might be viable. Still, in the short run, it could be costly.
Yeah.
Ben and Jordan, do you have something to add about blockchains without cryptocurrencies, or do you think they are solving fundamentally
blockchains without cryptocurrencies? I mean, it's such an easy base layer having a token program on a blockchain. I don't think there will be any such chains. I mean, I guess there's like maybe secret or something, but here's sort of another unpopular opinion. A lot of my compatriots are all about decentralizing all the things. I don't think you need to decentralize everything. Blockchains are just another tool, a decentralized database. I think there are a lot of cases where having centralized software makes a lot of sense, and I think there will continue to be. I think the real question, I think what Bobby said is a really good point. There has to be an entrepreneurial incentive for people to build things. And that's why the things that you're seeing people build on the blockchains are like super composable, decentralized finance protocols. It's because if you open up a finance protocol and you make it available to everyone and everyone can compose on top of it, you get much better capital efficiency than when you have a bunch of big players coordinating with like the NASDAQ, and they have to have their servers close to it, and they have to have a special chair that they buy, and they have to get whitelisted in, and they have to build all sorts of protocol connections that are very opaque. That is less capital efficient than decentralized finance. And it will always be, I think. So that's a case where there's more money to be made there. But I don't think, for instance, you're going to see like Shopify, for instance, convert its entire database system to be on chain. I think you'll see them convert their payment system to be on chain because there is a huge middleman problem in payments right now. There are only 3 big players and they take like 3% for merchants. And you could easily get that down to 0.001%. With a decentralized protocol that just has token holders that get profits. So I think there will always be cryptocurrencies on chains. I mean, that's sort of a different thing. I realize you're asking, but I think ultimately these chains will continue to exist and they will continue to draw people in where there's basically an arbitrage play to be made, where there's a protocol that's centralized, that sucks, that can be made more capital efficient by making it open and composable, which means to allow other people to build programs on top of it that drive it in different and interesting ways.
I'm pretty sure that the founder of finance would agree with you, as evidenced in his tweet on the first day of Chinese New Year this day. There's no blockchain without.
What did he say? Oh yeah, I don't think there's going to be any, like, there'll always be a crypto, and like even Solana, the reason that the Solana token exists, it exists strictly to pay the rent on storing data on the chain. Like, and I think most of the value that people impute to it, again, is like 90% psychology. It's 10% actually it costs money to store things. And that's why it exists. And it's tough to really do a different model than a currency model because humans are just really good at understanding the use of currency to buy things. That's why you end up with these tokenized, basically you're like tokenizing use, like usage power.
Ben, do you agree?
Yeah, I think, I agree. And I think there's 2 important things I would underscore: that not everything has to be decentralized because it doesn't necessarily solve everything. There's a real cost there. And I think you're going to start to see, I mean, a lot of big companies looking at this space, they're going to start to pick and choose what they decentralize. I think the Shopify example is a great one. There's no reason for them to decentralize their customer database. It makes sense for them to decentralize payments. I think you're going to start to see a lot more of the so-called hybrid chains, which is the membership rewards example you gave early on is, I think, is perfect. The credit card industry kind of showed us what this looks like very early on, or actually Bobby gave that example, membership rewards, where I worked at American Express for several years and I was shocked at the gray market for these Amex points that people would trade completely independent of the company. I mean, in many ways, there was, in that case, the blockchain was just, a ledger that American Express owned, detailing the records of who owned, which membership rewards points. And so I think you'll start to see a lot more of kind of, hybrid chains where there might be a private blockchain internally, or which is effectively just a database where batches of records, whatever it might be, or transactions might be uploaded to a separate chain. I also think an important concept there is permissionless. Not everything should be permissionless. Not everything is going to be permissionless. The crypto community was kind of up in arms when Aave Arc launched. But anybody who's a regulated, SEC asset manager knows that that is the only state of the world in which you're going to get mainstream institutional adoption. That's just how it's going to be. And I keep telling, especially, some of the programmers, the contractors we work with that are, the stereotypical, whatever it is, shadowy coders with, hoodies, and they're kind of ranting against it. And I'm like, guys, you're not going to have $100 billion pension funds participating in a market where they can't KYC the person on the other side of the trade ever, period. So I think you're going to start to see, TradFi blend with decentralized finance, but it's going to be a hybrid model, and there's going to be pools of capital and DeFi protocols that cater to kind of different parts of the ecosystem.
You know it, right? You're glad you brought up this permission versus permissionless angle and the hybrid angle. I think Ant-Chain or Huawei blockchain solution would agree on that, because by regulation, they're not allowed to use cryptocurrency in space. Yet they have to build a business around it. So it's interesting to see how this is going to develop. I know we planned to have some time towards the end for Q&A. I still have a few questions I want to pose, but let's take a quick look at these Q&As. I think some of these questions are really interesting, and we should talk about those. I know there's a question on how Mark Anderson was saying blockchains are just distributed consensus, and what is the essential element to blockchain, and why should investors use it? I think there's plenty of discussion on this issue. In academic studies, people have been defining blockchain systems as distributed or decentralized consensus as compared to a centralized registry. So there's that question. I'll just read a few questions and I'll let our panelists jump in with their responses. Another question is asking, what's your opinion about future regulation that's going to either help or hurt the space, especially concerning DeFi? And finally, there's a question on, Facebook, now known as Meta, definitely tried to build a platform currency or stable coin, but that was prohibited. How was that similar to a digital currency? Any thoughts on these questions from the audience?
I got lots of thoughts. I also see Jordan's addressing one too on
oh yeah, I just addressed one, and also my headphones went out, so I missed the question that you read, but okay. I'll probably pick it up from context when Bobby answers it.
Yeah, well, first off, on the distributed consensus point, it's such an interesting thing, because that's really what's happening in all these blockchains. There's a whole new ideological conversation around the world about how do we know what truth is? How do we know what truth is in a distributed way? And that's what the Satoshi Nakamoto white paper, Bitcoin, a peer-to-peer cashless payment system, whatever it's called, that's what it was addressing. And it set up this whole conversation, right? And leveraging technology. But there was this ideology about how do we get consensus truth, right? And I'd like to step back in all these questions, because I don't think the audience realizes how centralized the question is, in that this is mostly an American audience, okay? There are 7.9 billion people on the planet, and Americans are 330 million. It's a pretty big population, but it's only 4% of the global conversation, okay? And a lot of, when I find that when people are analyzing crypto and other things, all of us have these simplifying heuristics. It's good or bad. It's a 0 or a 1. It's a black and white issue, right? Very clear or not clear, right? In order for you to understand what's happening in any of these conversations, you have to hold multiple conflicting ideas in your head simultaneously and go to these gray spaces, right? And so try that when you start resisting something that doesn't make sense, or that's a simplifying heuristic in your mind. You got to limit that in order to really onboard what's happening. The last thing I would say, back to this distributed consensus question, as it tie all that together, is Bitcoin was one proof of work way of saying, here's how consensus is created. Then other people started saying, what are other ways we can create consensus? Proof of stake, right? The purists in Bitcoin said, well, that's bad because that's a step towards centralization. Whereas other people said, well, there's efficiencies and other things that we got to solve for. So there's all these different blockchains and robust discussions. And I find that interesting as a venture investor to say, all right, why don't I just spread some bets across the ideologies? So I'm kind of betting on the ideologies around how you create consensus truth in different crypto ecosystems. So that's how I would address that question, and defer to the other panelists on whatever they want to discuss.
Very interesting. Ben, do you want to?
Yeah, I mean, I would echo that exact sentiment. I mean, the only thing I would add is, again, as institutional investors, and we deal with a lot of investors who are very kind of crypto skeptical, but now they're kind of, for a lot of institutional investors, 2020 was really kind of the watershed year in which they were forced to reckon with Bitcoin or digital assets as an asset class. I like to point to the Paul Tudor Jones letter of May 2020, where he himself talks about, we've kind of crossed the Rubicon globally in terms of, monetary stimulus. We're at a point where I think he cites, 30 or 40% of all US dollars were printed in the last few months. And so he's talking about stores of value. He talks about gold, of course, but then he talks about Bitcoin as something that we can no longer ignore. And that's when we really started to see attitudes shift. And there was kind of a bifurcation in that population. One was just simply saying it's digital gold. Gold doesn't do anything. Buffett hates gold because, all it can do is sit there in your backyard. It doesn't pay a dividend. But if somebody else is willing to pay for it, then it has some kind of inherent value, and they assign that to their, the digital assets landscape. Others, understand that there's a network effect. It's much more like technology in the early 90s. And, I think the ideological bet is a great example of the way that a lot of those investors are thinking about it. And they don't necessarily have to have a call on which protocol or whether it's Bitcoin or Ethereum. This is something new. It's here to stay. It does solve real world problems. What that exactly looks like, we don't yet know, but it's worth making a bet on the space. And so that's kind of, from an institutional investor perspective, that's the paradigm shift we've seen, is a lot of crypto skeptics kind of coming over the wall and saying, okay, it's either got value for the same reason gold has value, and we're going to buy it for that reason, or it's got value because this is much more like QQQ technology stocks, again, in the 90s. And even if I don't understand it, I know that, technology is going to be transformative. We'll make a bet accordingly.
Yeah, and on your point about network effects, so on and so forth, all these are features that we have to price in when we think about valuation. I just want to point everyone's attention to, there's quite a number of academic studies, and for example, my co-authors and I have worked on dynamic pricing of platform tokens. There are ways to think about pricing the utility flow similarly to how we price derivatives, for example, using Black-Scholes formula, so on and so forth. And there are also important issues related to the optimal token allocation policy, the optimal monetary policy at the platform level, right? So these are all very interesting areas to explore. I know Jordan has been responding to questions in the chat as well. But let me just mention another topic, a set of questions that I really have been thinking about and would love to hear your thoughts on. That is related to the dark side of crypto. Other than maybe some tokens of DeFi projects being potentially bubbly, what are some of the dark sides that you are concerned with, or significant risk that you think DeFi or token projects face? For example, we've seen a lot of wash trading by exchanges, by individual traders. We've seen tax loss harvesting using cryptos and NFTs to get into that gray area of.
Look, I actually welcome it. I love when people think that they can use crypto for money laundering or other things and get away with it. It's hilarious to me because of how stupid it is. I think like 5% of fiat cash transactions in the world are money laundering, and those are much better because there's no ledger. But then people come onto like these chains and they do their little illegal act, and the beauty is it's all stored on chain forever. And they can't take the money out of the chain unless they go through one of several centralized exchanges like FTX or Gemini or something, where they have to be KYC'd in order to get back to their original account. So they end up stuck with their money, like sort of floating in this wallet they can't use forever. All they can really do is buy NFTs with it. And so I welcome it. I think the decentralized, ledgerized world is a much more scary place for criminals. And so I think what illicit activity does happen on there is probably better off on there. I would much rather have them using the ledger system than passing around bags of cash in vehicles. Because I mean, this is why China is so interested in having their own digital currency. They understand, no one understands how better to crush and control people in the Chinese Communist Party. They've been doing it for like 90 years at this point, and they have it down to a fine art. And they know that a decentralized ledger to which they hold the keys is the ultimate way to make sure that no one can ever step out of line again. Because it used to be 20 years ago, if you had yen in a bag, you could still do something illicit. Now you can do nothing illicit if you move entirely to digital. So I actually think it'll lead to a weirdly a safer world, just having this stuff. And I think also you'll see this large growth of companies that solely focus on sort of digital sleuthing. Like their whole job is, because I already see it, like when there's a hack, like when there was the wormhole hack or the recent hack with Sabre, where Sabre got hacked for 50 million and change. There were people who were writing these little tools for sort of scouring the blockchain to put together all the hacker accounts and trace sort of the flow of funds. I mean, good luck doing that with a bunch of Cayman Island accounts. So yeah, I actually have a bit of a contrarian view. I think that it actually makes the world less illegal. I think fiat cash is actually the most dangerous thing you can have for a world filled with criminals.
Well, I think actually to that point, so interestingly, if you go back to the infrastructure bill, there was all this talk of illicit transactions and Congress was just kind of woefully ignorant. Fast forward, I think it was just a couple of weeks ago, the Treasury itself came out with that exact statistic that Jordan talked about. They said, 5 to 6% of all fiat transactions are black market, whereas it's less than 1% of cryptocurrency transactions, because people have now figured out it's not as simple as just, running money through a tumbler. You're going to get caught. So yeah, I mean, I think to answer your point, Will, though, I mean, the dark side, I think, is just the fraud. There's a lot, and that's one thing we have clients that are like, they get the FOMO, they want to jump into the next NFT project or the next, tiny altcoin or something like that. We're constantly telling them this is still, there's a lot of pets.com out there. There's a lot of eToys out there. I mean, you've really got to be careful. And the regulation just simply, it's, they've got to just kind of take it one thing at a time. And right now, it's stablecoins is the focus. So I think for investors, that's the key.
Yeah, I agree on the fraud. Like that's one thing. And that's the sort of the funny thing is like, it's tough to regulate your way out of fraud. Like, it's like when you make guns illegal, like, do criminals really care? The people who weren't going to carry guns anyway, just continue to not carry them. The same thing is true of fraud on the chain. Like if you say, hey, it's illegal to steal money from people by selling them an NFT where you make a false promise about utility, people will still do it. And it's still a risk. And it's just basically the human condition playing out in another playground.
And I think safe to say that these are areas worth watching as regulation continues to evolve. And also, in terms of ransomware attacks and rug pulls in the crypto space, things like that. It's interesting to have these different perspectives and see how that's going to exactly play out. I wouldn't venture too much into the communist part, but talking about decentralized systems, we know incentives matter. I would view Chinese main motive for developing digital currency as a way to compete or get back control from the private parties, private firms, such as Alibaba or Tencent. And there's a debate to be made on, whether it's best to leave it to the hands of private firms versus a government. I think many countries face that struggle as well. But I want to save some time for Q&A, additional Q&A from our audience. But before I do that, just any quick comments on emerging trends of exciting developments in the space, in blockchain, in DeFi, NFTs, and maybe the next metaverse, the next generation of innovations that you've observed.
Yeah, the metaverse one resonates with me. I mean, I was on a call earlier today with somebody on the front edge of this, and I was a nerd in college. I went to Georgia Tech. I played World of Warcraft and all that stuff, so I understand video games. And Avatar, the movie, made a lot of money for a reason, right? There's something about us that we all have. There's some gamification or kind of alternate egos or fantasies that we want to live out, and video games are a form of that. But then once I kind of got past that and I saw like, there's like digital fashion shows where people can buy digital dresses to dress up their avatar, and that's an NFT. And you can do kind of training and gamification of education, all that stuff. I think the metaverse, it's not for, and again, it's not, it's stupid or it's great. There's a gray area there. And there's a lot of people that really enjoy it and are going to continue to invest in it. I mean, JP Morgan opened up a metaverse bank, right? I mean, just think about that. What does that mean? Like, why would they do that? It's a big institution that was actually cynical about it initially. So what are people doing in the metaverse that is either for entertainment or skill or other things? And what are the things that can be digitized in the little digital ecosystems inside of those? That's an interesting thing that I'm personally digging more into.
Very interesting. Ben and Jordan, what are your thoughts?
I mean, the interesting thing we see is, again, kind of more traditional use cases of blockchain and NFTs, in particular. So you think about, tickets, just any kind of tickets, whether it's for a Live Nation concert or a movie theater or whatever. I mean, that's, that an NFT is a very easy way to, provide access rights with all kinds of other, additional fan type of engagement. I mean, I think you're going to start to see it explode in the sports space. The major league sports, they all have kind of a fan engagement issue. NFTs, and whether or not it's embedded in some kind of play to earn or, legalized gambling or fantasy component, who knows? But NFTs are kind of a very easy way to engage a fan base. So I think you'll start to see a lot more kind of real world use cases of NFTs impacting our everyday lives, which is interesting. And then last, in traditional finance, it kind of went underreported, but, SocGen, lobbying the MakerDAO Foundation to, refinance a $20 million bond, I think was very interesting. That's a small number for SocGen. It was, very much a kind of an academic use case for them, but that's a good example of, I think, trends we're going to start to see. The DeFi is interesting because it cuts out a huge middleman layer, which is why, in part, yields are high and costs are lower. And I think you're going to start to see more, especially as we, if we get into a recessionary environment where cost starts to matter a lot more to people. They're going to be looking to, save nickels where they can. I think DeFi is going to, become a prominent contender with more traditional financial institutions.
Very, very interesting. And Jordan, do you have more to add there?
I don't, merely because I was answering a question on the on the Q&A, so I wasn't entirely following.
Yeah, we were just talking about the emerging trends, and I think part of that is there could also be some synergy. DeFi, sci-fi, how we link things from on-chain to off-chain across different systems could all be very interesting.
Yeah. I mean, I see, like, so do you remember Lending Club? I mean, it still exists, but do you remember when it came out? Like, I remember when I first went on there, I was able to get yields of like 30%. Like, it was amazing. And it was primarily because it was new, but also because suddenly they had sort of fractionalized lending. Whereas before only big players could do it with other big players, suddenly anyone could get in on it. And, sort of the theory I had at the time was like, well, I think really the big players were getting these rates all along. They were just giving their investors lower rates and making money off the difference. Essentially, they were acting as a middleman on technology that was hard to use, and lending clubs sort of broke that wall down. Anyone could now provide collateral, even if they only had $100. DeFi is kind of doing that on a larger scale. It means that just independent investors can, collateralize anything, and they can get the same yields that these large institutions get without the middleman fees. That's why the interest rates are higher. Now I'm talking, I'm talking about, the good DeFi protocols that actually are producing something of value. That being said, there's also a whole argument to make, like, okay, now that you have these retail investors on board, should there be regulation protecting them? Because they are just not as sophisticated as the guys who are calling up hedge funds and dumping in 5 million. And I think that's a reasonable discussion to have. But I do think that DeFi is going to make raising funding a lot more capital efficient. And I do think in the long run, the wisdom of crowds does, I think, work better than the wisdom of large bankers, like large scale banks and institutions. Like, there's just more people, they're doing more research, they're spreading it. I think ultimately it'll be for a greater good. That being said, I think there will also ultimately be regulation on it. And it will be interesting to see how far the pendulum swings one way or the other once that discussion is had in Congress.
More crowd-based mechanisms. And you did on this capital formation, that's in the Q&A as well. I think David Weinstein was asking, what do you guys think about crypto as capital formation tool? Of course, we've seen a huge episode of ICO and IDO, all types of fundraising. Actions in the space.
I love capital formation as a good DeFi example, but the thing is, personally, I also don't like anonymous teams. So I think there's a real danger there with fraud. I mean, it's true to some extent with like raising money with a company inside the United States, like you can look at Theranos, for instance. I worry about that in crypto. I worry about people raising capital in a sort of an undoxed, hidden way and just disappearing with the money. I think it is easier than, say, what happened with Theranos. There actually is legal retribution going to Elizabeth Holmes for that. If you have an undoxed founder, you could raise a bunch of money and nothing could happen potentially. So I think there's still an imbalance there. And it's a popular thing for a blockchain engineer to say, but I do think there needs to be some sort of, maybe just industry-wide like rules, like maybe, we just decide to develop wallet software that doesn't let you invest in ICOs that don't have some sort of certification from some third-party authority, something like that. So it's like basically a wallet that has special software around it to not let you buy stupid things unless you like click yes several times. And then you have this whole protocol around it where companies that want to sell you things but want to be doxed have to like send their documents to some independently decentralized authority where there's a bunch of auditors that get paid by some token in exchange for verifying that these documents are true and storing them in some encrypted vault so that they can be given over to law enforcement in the event that something bad happens. Something like that, I think, is the future. I think these raw wallets we had today where you can accidentally send $100 to someone and lose it entirely, I think those days are numbered. I think ultimately what will bring people on is when crypto wallets start acting more like a credit card where there's a dispute resolution mechanism and you're only working with merchants that have met some minimum bar of KYC. And it may not be regulatory that makes it happen. It may be some enterprising individual or set of individuals develop a protocol where they basically just get a cut for having provided this protocol. Then they get network effects working for them.
Well, yeah, I think that's back to the hybrid point. I think the market's going to start discriminating. And I think that, again, this is where the wisdom of crowds, big institutional pools of capital aren't going to interact with most DeFi protocols. So what happened? Aave responded by creating a permissioned layer. And you're starting to see more of that. So I think you're going to start to see people vote with their dollars. And there's two distinct pools of capital. There's kind of the early degens that are fine with custodial wallets and they YOLO into everything and lose money. And then you've got the larger institutional pools of capital that are coming in and saying, no, there's no way we're playing with undoxed teams in a completely anonymous environment. We demand some minimum standard of transparency, et cetera. So I think the market will solve for that, but it's coming.
And we're seeing that on Solana too. Serum, which is like the decentralized exchange software, they have permissioned DEXs now. Where you have to have a special key to sign to make an order or a sell order on that DEX. So the markets are adjusting. And the beautiful thing is there hasn't been any regulation yet. It's just like you said, the money is there. The institutions want in, but they want in under certain guidelines.
That might be coming given the recent.
Oh yeah, I think it will be.
And everything.
But I always think that if you beat the regulators to the punch, they're always a little less punchy. If you do the right thing first. So there's that.
Great discussion. And I do want to highlight one more very interesting question from Kathy Hotty. If we are destroying the universe in the creation of Bitcoin or crypto, and there's no real value left, why are we continuing to produce? I think it has something related to POW versus POS, the environmental effect, and sustainability. I know some of my colleagues here at Cornell are actively working on that. Ari Jules, as well as Prasad, we're producing a big Q&A on proof of work and environmental impacts. What are your views on this aspect? ESG dimension, sustainability coming in.
Well, I interpret her question differently, but I'll just quickly respond. I don't think we're destroying the universe at all. I think we're building on all the systems that are there, and there's a new conversation emerging. That's what crypto represents. So I think about it. I don't think Bitcoin has no real value. I think Bitcoin has fundamental value, which is the reason it continues to grow. It's a fixed supply. You have full sovereign portability in your mind. If you remember your private key and your public key to transfer $1 trillion in your head, that's extremely powerful. If you're an immigrant leaving country X, think of countries, friends of mine, Lebanon, for example, like currency was off 80% before the blast 2 years ago on August 4th, right? Their central authority is not acting in the interest of the people. And think if you could leave with all of that Bitcoin in your head and they can't take it from you, that's extremely useful, extremely valuable in a global conversation, okay? And, but there are a bunch of crypto coins that are not real value, but I think there are many that are, and that's a venture conversation. On the environmental thing, well, nobody ever says, well, what's the existing environmental impact of the traditional banking system? The assumption in the question is that the cost is zero, which is
exactly.
ridiculous.
Exactly.
So like,
I think it's grandfathered in, guys. We don't ask questions about that.
Yeah, that's right. Yeah. Bobby, you're asking too many questions.
I know.
Right.
Sorry, guys.
We're gonna see a black hand pull them off screen in a second.
That's right. So I think the environmental impact of Bitcoin and crypto is just way overstated, and it's a convenient narrative for people to just ignore it,
And even there, I would argue you're starting to see the market respond, right? I mean, we do a lot of, separate from crypto, we do ESG work. And so we interface with people where they're very ESG minded, and you're starting to see them, express interest in crypto, but it's only, proof of stake chains, or it's only miners that have, renewable energy as their source. I think it was Hive Mining has a deal with the government of Sweden to, plant their miners in greenhouses, nationalized greenhouses, in exchange for free electricity that they get from, geothermal. They vent their heat back into the greenhouses so Swedes can have tomatoes all year long. So again, the market is starting to vote with their dollars, and that's, that's consistent with the entire ESG movement, and crypto's, just a part of that.
I have to do a plug here because they make me do this for Solana Labs. I would like to say that a single Solana transaction uses less energy than 2 Google searches. And we buy enough carbon credits every year across the entire chain, like all of us together, to offset it. So it's carbon neutral. So I don't know what the other chains, but this chain, carbon neutral.
Very interesting statistics.
Yeah.
Thank you all. I do want to be mindful of time for our guests and our audience. We are going to stay a little bit longer to, take more questions. But I do want to kind of officially conclude. I want to give a big thank you to Bobby, Ben, and Jordan for all your insight today. At the end of the event, to the audience, you will see there's a notice of to complete the survey about today's event, and your feedback is going to help the society when planning future events. And that feedback is going to be very much appreciated. So if you have any questions about today's event, please make sure you reach out to the CFA Society Chicago office at info@cfachicago.org. So I think we can take some more questions from the audience if our panelists wouldn't mind. But I want to kind of officially conclude today's panel. Thank you all. If there are questions from the audience, I think you have a opportunity to either type it in the chat box, or you can unmute yourself and ask the question directly. If you can raise your hand, that would be
Here, I'll do this first one. Here, I guess I click answer live. Okay. So the question is sort of, how do you tell institutional investors to invest in various digital assets? Like, how do I go to a KKR and say, and give them instructions on how to invest in digital assets? I mean, there's kind of 2 ways to do it. One way is just to go with the top 5 cryptocurrencies and just create an index. And that's probably a nice, easy way to do it. We won't go into how you store that crypto. Custody of crypto is a whole other ballgame, but I'm talking about strategy. The other strategy, which is kind of interesting, is I hearken back to the early 2000s when there were companies that were hiring 13-year-olds who had learned how to code on the web to build their websites. Before there was really a large pool of actual experienced engineers, and these kids were just building websites for people because they understood how, and they were building them for large companies, like large brands. I think something maybe I have seen some firms starting to hire, I guess you'd call them credible degenerates, people that have large Twitter followings and have posted the plays that they are making well in advance of making them, and then those plays have turned out to have high alpha relative to the market. I think if a firm wants to get into crypto and they actually want to explore sort of a real alpha situation, maybe try hiring a stable of people that have made their own money on crypto, sort of their own flesh and blood, and they have a social presence. They have talked about coins in the past that they invested in, talked about NFTs they invested in, and they have a good hit rate. I mean, these people are out there. There are stock pickers out there that do the same thing. They make projections on Twitter. They turn out to be right more often than they are wrong, and you only need to be right 51% of the time. There are many degenerates who are right like 60, 70% of the time because the ecosystem's so small and they hear things. So if you really want to make money in your big institution, just give some people that have already done it with small amounts some more capital to work with. And that it's kind of an unpopular suggestion. It's a little risky, but you're going into crypto. I mean, your safest bet is Bitcoin. It fluctuates by like 20% in a week. That's like the crypto bond is something that fluctuates by 20% in a week. It's just a different ball game.
Yeah. And I think for the CIOs of the pension plans and all that, that's what I'm kind of hearing in this question too. I agree. Just go buy an equal weighted blue chip, top 5, top 10, like Jordan said. How you do it, if you go to Coinbase, there's a question of who holds the keys and the access, and you got to set up a governance structure in-house in your portfolio management team. That's a conversation. That's a real conversation, but that's a way to do it at low cost, and you'd kind of direct ownership. But if that's not what you want, you go through managers. There's a lot of great Pantera Capital to me is the premier kind. It's expensive, 2-20 to 3-30, but you've got a huge institution there that's got a lot of experience in the space. Wave Financial's another one. Arca's another group of kind of traditional Wall Street folks that got into crypto. There's a lot of really big platforms out there that have a range of products, and you just got to go through your normal due diligence process. But you're holding just a venture portfolio position in your portfolio. That's how you could access it. And then there's all sorts of other just traditional venture capital funds out there, the 776 fund that Ohanian did, Reddit, all that. I mean, there's a lot out there. And so you can go in through traditional structures that express the underlying bets that we're talking about here in the space. That's how I would do it if I was a large institution.
Yeah, and very, very useful advice to large institutions, I would say. Kind of speaking of large institutions, there's a question in the Q&A box that's asking about what do you think is a good thing to potentially have 401k programs that provide the ability to invest in digital assets, right? That's large pension funds, large institutions, for sure. Is that something you would foresee coming, or?
Yes,
it's definitely coming. And it's part of the risk tolerance question, like anybody else. Does it make sense for a 65-year-old that's about to retire? I don't know. Probably much less so than the 22-year-old that's just starting their career. So it's it's an asset class like anything else. It's got risk return characteristics. I mean, to underscore what Bobby said, it's got it's important to understand that this is a level of volatility and drawdown that most investors are not used to thinking about or dealing with. So it is way out there on the risk spectrum. But it's another asset that can be invested in, and so it makes sense for some people, it doesn't for others.
Yeah, I have regularly. I mean, this has happened multiple days. Maybe I could say 20% of the time, I open up my phone to look at my net worth. It has swung by 30% in one direction or the other. There have been 60% days. It does take a lot of stomaching, and I just keep having to say to myself, I'm 34. Got 30 years left. 34.
Right.
I've got 30 years left.
Hodl, man.
Yeah, hodl. I do think, like, for instance, pension plans have really screwed up. Like, they're terribly run, often perform under the market. I learned this in my investment class. They just do a terrible job. And especially like California pension funds are the worst of the worst. Yeah. I think because they have fallen so far behind their obligations, I do think you'll start seeing more investments into crypto simply because they just adopt a larger risk appetite because they need those larger returns to meet their obligations that are coming up in the near future.
You talk about risk return trade-off and also viewing this as a new asset class. I just want to point out there's a large and very active literature trying to study what pricing factor or risk factors would be present in terms of explaining the cross-section of over 8,000 different cryptocurrencies, and also models that's showing significant segmentation across different types of tokens. they have very different co-movements, patterns, so on and so forth. Very interesting development. It's hard to tell if it's already in some steady state or it's very much in transition.
I mean, I'll tell you, we run a bunch of, actively managed rules-based funds for institutions, and we have a lot of machine learning programs, natural language processing, all done in-house, a ton of research on the space. And I can tell you that we track hundreds of different features in our machine learning data sets. And it's interesting to observe what matters now that didn't matter at all, 6 months ago. Things, covariance is an obvious one, but it's, part of what I like to point people to is if you look at the rolling 60-day correlation of Bitcoin to the NASDAQ, it went from bouncing around zero since inception to going basically categorically positive post 2020, and now it's at all-time highs. So that right there is just a very easy heuristic to understand that something has changed. Now it's obviously institutional capital moving into the space, but it's changing the risk return dynamics. It is starting to, things are different. So it's very much in flux. And it's a tricky problem to solve, but these are the things that institutional investors are contending with. Is how do I think about this in the context of an endowment portfolio or a 60-40 portfolio? It's not necessarily just as easy as sizing it super small because it's got to move the needle. And again, the effect that Jordan mentioned is very real in the institutional investor space. Is there, let's take Bitcoin out of the picture. The world 10 years from now or the next 10 years is going to be very different than what we just came off of. With kind of QE suppressed, Fed bid for all assets. So people are looking and saying, I got to hit my numbers to pay out my, public school teachers and firefighters. What am I going to do? It's value stocks probably isn't going to do it. So there's very much a new audience for, asset classes that can potentially, hit big numbers.
Absolutely. And just to your point about the empirical pattern, economic theory actually predicts new asset classes, as they grow in size, they're going to become more correlated with other asset classes. So there's a lot of interesting areas for future research as well, both in the industry and in academia. I do want to wrap up since we are.
Before we go, Will, I actually have a question for you. Given your algorithmics background, what do you think of the stock to flow model with Bitcoin? Like, what's your feelings on it?
Sorry, what is that stock to flow?
The stock to flow model that this guy, he sort of predicts how Bitcoin is going to first start. It's going to start acting like real estate, and then it starts to act like a stock, and then it starts to act like a currency. And each time it sort of steps up in value. It's got this graph, and in fact, it's it's like a 10-year graph, and I think we're in year 5, and so far Bitcoin has been following it pretty much within one standard deviation. If you're not familiar with it, then the question is moot. But I thought you might be.
Particular way of approaching it. I do have a opinion on Bitcoin. I like to tie it to fundamentals, and to the extent that we treat Bitcoin as a general payment token, we have to think about the functions that money typically provide. And I think you would all agree it's not a unit account due to high volatility. It's not a medium of exchange. I don't use it to buy coffee.
Only a store of value.
People can argue it's potentially a store of value. Then, of course, compared to digital gold, why is that a special store of value? We can talk about algorithmic scarcity that's created based on the market cap, but that's only on the what economists would call intensive margin. If you look at the possibility of creating just other cryptocurrencies on an extensive margin, there's no cap on it, right? There's of course coordination and everything. So
it's just like the US dollar.
Exactly.
Exactly. Yeah, there's no cap on it, right? Which is fully sound and backed by gold and all that stuff, right?
But it's not backed by gold anymore. It's backed by guns.
Yeah.
Yeah.
And, I think there are interesting developments on should we install almost like a central bank type of governance on the monetary rule for certain tokens versus purely algorithmic, so on and so forth. But very, very interesting to definitely explore and research more on. But with that, I just want to say thank you again. And for those of you who are still in the audience, please, if you get a chance, please provide the feedback through completing the survey about today's event. And if you have any questions, please contact the CFA Society Chicago office at info@cfachicago.org. Thank you very much.